Okay, so you want to own a movie studio, the most powerful creative machine in Hollywood, a vault full of characters that billions of people already love, a production pipeline that turns comic book pages into $2 billion weekends, and a brand so dominant that simply announcing a release date moves financial markets. That's the picture. That's what Disney bought when it acquired Marvel Entertainment in 2009. And for about a decade, it was everything that pitch promised. Here's what that picture doesn't show you. In 2023, 2 Marvel movies combined cost $762 million to make. Together, they lost nearly $300 million. The lowest grossing film in the history of the Marvel Cinematic Universe earned just over $200 million at the global box office. And the studio that turned a $4 billion acquisition into the most profitable franchise run in cinema history is now being openly described by Wall Street analysts as running a brand that's moved from sure bet to risk loaded. By the end of this, you'll understand exactly why even a $2 billion box office number doesn't mean what most people think it means, why the most successful franchise in movie history started losing money, and what actually separates a year where a studio prints money from a year where it burns through it. Before we get into the numbers, you need to understand what a movie studio actually is, because the image most people carry around is a romanticized version of the real business. A studio is really a content manufacturing and distribution company, one that bets hundreds of millions of dollars on individual products, each of which lives or dies in a single opening weekend, and each of which has to clear an enormous financial hurdle before anyone inside the building sees a dollar of profit. Here's where that hurdle comes from. When a major studio releases a film, it splits the box office roughly 50-50 with the theater chains showing it. That split varies, and studios typically do better in the first weeks of a run. But as a working rule, for every dollar a film earns globally, the studio takes home around 50 cents. A film that earns $2 billion at the box office generates approximately $1 billion in studio revenue, not $2 billion. That distinction is the single most important number in this entire business, and most people who talk about box office results never mention it. Then there's the production and marketing equation, the part that catches almost every first-time buyer off guard. Major studio tentpole films, the kind built around established franchises and designed to open globally on the same weekend, routinely cost between $200 and $300 million to produce. But the production budget is really only half the story. Marketing a global tentpole typically costs another $100 to $200 million, meaning a film with a $200 million production budget can require $300 to $400 million in total before a single ticket is sold. Let's talk about the number that gets all the attention first, the acquisition. When Disney paid $4 billion for Marvel Entertainment in 2009, it was the most talked about deal in Hollywood. The price tag seemed enormous for a company that had, at that point, produced only a handful of films under its own label. Iron Man had been a success. The Incredible Hulk had been a disappointment. The brand had potential, but whether that potential was worth $4 billion was genuinely uncertain. What Disney was really buying wasn't the films that had already been made. It was the rights to over 5,000 Marvel comic book characters, a library of intellectual property that could theoretically generate films, television shows, merchandise, theme park attractions, and licensing deals for decades. The characters were the asset, not the current output. And for approximately a decade, that bet paid off in a way that's almost unprecedented in the history of modern entertainment. The Marvel Cinematic Universe built something the movie business had never seen before, a serialized universe of interconnected films where each individual release both stood alone and served as a chapter in a much larger story, one that rewarded audiences who watched everything and still made sense to those who didn't. From Iron Man in 2008 through Avengers, Endgame in 2019, the franchise accumulated more than $30 billion in global box office, making it the highest-grossing film franchise in history. Endgame alone earned $2.79 billion, making it the highest-grossing film ever made at the time of its release. The return on that $4 billion acquisition, when you account for box office, merchandise, licensing, and the halo effect on Disney's theme parks and streaming platform, has been estimated at several multiples of the original investment. By the most conservative reasonable measure, Disney's MCU generated returns of over 3 times its original cost in under 15 years. But here's the fact that stops most first-time buyers cold. Endgame wasn't just a peak, it was a ceiling, the culmination of 22 interconnected films, 10 years of careful audience investment, and a cultural moment that may not be possible to manufacture a second time. What came after it revealed something fundamental about the economics of owning a franchise. The value of a cinematic universe depends almost entirely on the audience believing every entry matters. And that belief, once it starts to erode, erodes faster than any studio can reverse. Here's how the erosion actually showed up in real numbers. After Endgame, the MCU began releasing more content than ever, both in theaters and on Disney's new streaming platform, Disney+. The logic was straightforward. More Marvel equals more engagement, which equals more subscribers, which equals more streaming revenue. The problem was that audiences had limited time and attention, and a model that had trained fans to watch everything began to feel, in the words of some of the studio's own creative executives, like homework. Casual viewers started dropping off. Even committed fans began choosing which releases to prioritize. The financial consequences arrived in 2023. Ant-Man and the Wasp: Quantumania, one of the most expensive films in MCU history, earned $476 million globally. That sounds like a large number until you account for the theater split and the production and marketing costs, at which point it becomes a significant loss. The Marvels, the follow-up to the billion-dollar Captain Marvel, became the lowest-grossing film in the history of the franchise, earning just over $200 million against a total cost approaching $500 million. Disney's own financial disclosures confirmed that the two films combined generated a loss approaching $300 million. Two movies, one franchise, $300 million gone. Against this backdrop, the streaming strategy was generating its own losses. Disney Plus accumulated approximately $11 billion in cumulative streaming losses during its first years of operation, driven in part by the enormous production budgets of the exclusive Marvel and Star Wars content designed to attract subscribers. The shows worked, in the sense that people watched them. The economics didn't, in the sense that the cost of producing them far exceeded what the streaming subscription revenue could justify. There was one genuine bright spot in the recent period. Deadpool and Wolverine, released in 2024, earned $1.3 billion globally, becoming the highest-grossing R-rated film in history. But one outlier hit doesn't reset the underlying trend, and analysts covering the studio were already noting something that executives at Marvel were also acknowledging quietly in interviews. The brand that once sold certainty, the brand where announcing a release date guaranteed a massive opening, had become a brand where each release now carried real commercial risk. Let's build the two honest scenarios, because this is where the real picture comes into focus. In the good year, you have an endgame, a film or a pair of films that arrive at the end of a long, well-managed narrative arc, with an audience that has been building emotional investment across years of prior releases. The marketing almost runs itself because the cultural conversation does the work. Opening weekend shatters records. The theater split still means you're only taking home 50 cents on the dollar, but on $2.8 billion in box office, 50 cents on the dollar is still an extraordinary return. Merchandise sales spike globally. Theme park attendance climbs. Streaming subscribers come in to watch the content leading up to the film. Everything moves together. And then, in a single difficult year, the calculation flips. In the bad year, you have a Marvels, a film that made creative decisions audiences didn't connect with, released at a moment when franchise fatigue had already set in, carrying a production cost that was never designed for a $200 million global result. The theater split, the same 50-50 structure that worked so beautifully in the good year, now means you're taking home $100 million from a film that cost $450 million to produce and market. The loss doesn't feel like a bad quarter, it feels like a structural problem. Because in the film business, you can't unspend a production budget once the cameras stop rolling. That gap between a franchise that's firing on all cylinders and one that's lost its guaranteed audience status is the entire story of owning a movie studio condensed into one film slate. And unlike a casino or a ski resort, where the underlying asset retains its value even in a bad year, a film studio's most valuable asset, its audience's trust, can erode between releases in a way that no amount of capital spending can automatically reverse. So here's the honest question. If the best managed, most successful franchise in the history of cinema can go from Endgame to losing $300 million in the same decade, what does that tell you about the underlying business of owning a studio? The honest answer is that the same thing that made the MCU extraordinary, the belief that every release was a must-see event, was always the most fragile part of the model. Audiences don't owe a franchise their attendance. They pay attention voluntarily, and they stop paying attention the moment the implicit contract, "every film matters, every film rewards your investment," gets broken often enough. People think they're buying a content factory. The operators who actually understand this business know they're really buying something much harder to manage than a factory. They're buying a relationship with an audience, and relationships, unlike factories, can't be rebuilt just by spending more money.